Hello everyone, welcome back to my channel. So in the previous episode we looked at the relative strength index, and today I'm going to go over the stochastic RSI. So it's very similar to the previous indicator, but it has some differences. Okay, as you can see here, I'm back on Investopedia.com. Very useful website for going over indicators. So what is the stochastic RSI? The stochastic RSI is an indicator used in technical analysis that ranges between 0 and 1 or 0 and 100 on some charting platforms, and is created by applying the stochastic oscillator formula to set a relative strength index RSI values rather than to standard price data. Using RSI values within the stochastic formula gives traders an idea of whether the current RSI value is overbought or oversold. The RSI oscillator was developed to take advantage of both momentum indicators in order to create a more sensitive indicator that is attuned to a specific security historical performance rather than a generalized analysis of price change. Key takeaways. The stochastic RSI reading above zero point 0.8 or 80 is considered overbought, while a reading below zero point 0.2 or 20 is considered oversold. Overbought doesn't necessarily mean the price will reverse lower, just like oversold doesn't mean the price will reverse higher. Rather, the overbought and oversold conditions simply alert traders that the RSI is near the extremes of its recent readings. A reading of 0 means the RSI is at its lowest level in 14 periods, or whatever look-back period is chosen. A reading of 1 or 100 means the RSI is at its highest level in the last 14 periods. Over other stochastic RSI values show where the RSI is relative to a high or low. So the formula for the stochastic RSI are as follows. Stochastic RSI equals RSI minus the minimum RSI divided by max RSI divided by the minimum RSI. So RSI equals current RSI reading. Minimum RSI equals the lowest RSI reading over the last 14 periods. Max RSI equals highest RSI reading over the last 14 periods. Now, when it says 14 periods, that means it's the last 14 bars. Now, this can be this look back period can change. You can set it yourself, but as default, most traders just use the last 14 periods. Now, I don't want to get into detail of how the formula works, but I just wanted to give you a quick overview how the stochastic RSI is calculated. The difference between the stochastic RSI and the relative strength index RSI, they seem similar, but the stochastic RSI relies on a different formula from what generates RSI values. RSI is a derivative of price. Meanwhile, stochastic RSI is a derivative of the RSI itself, or a second derivative of price. One of the key differences is how quickly the indicators move. The stochastic RSI moves very quickly from overbought to oversold, or vice versa, while the RSI is much slower moving indicator. One isn't better than the other. Stochastic RSI just moves more and more quickly than the RSI. Limitations of using the stochastic RSI. One downside to using the stochastic RSI is it tends to be quite volatile, rapidly moving from high to low. Smoothing the stochastic RSI may help in regard. Some traders will take a moving average of the stochastic RSI to reduce the volatility and make the indicator more useful. For example, a 10-day simple moving average of the stochastic RSI can produce an indicator that's much smoother and more stable. Most charting platforms allow for applying one type of indicator to another without any personal calculations required. Also, the stochastic RSI is the second derivative of price. In other words, its output is 2 steps away from the actual price of an asset being analyzed, which means at times it may be out of sync with the asset's price, with an asset's market price in real time. So I'm now in TradingView and I am just looking at the price of BTC. And on the top here, I have the relative strength index, just your normal RSI. And below, I have the stochastic RSI. As you can see in the chart, there is some key differences between the two. So I'm going to show you the stochastic for RSI. So as you can see, there are 2 lines. There is a blue line, which is called the K line, and which moves faster than the orange line. The orange line is called the D line, which is the signal line. So from the previous video, we seen the RSI, just the relative strength index, only had 1 line. So this is the one main difference. The stochastic actually has 2. So the blue line here is the fast line. So it moves a lot quicker than the orange line. And it tracks the recent close in relationship to the recent range. And then the orange line, which is the slow line, also known as the D line or signal line, is a simple moving average that's done in the previous 3 periods of the percent of the K line. That's how the orange line is calculated. Now, the orange line is a lot slower moving. It trails behind the blue line. So I know this might seem so complicated. I wouldn't get too bogged down on the technicalities of how they're created. So I will just go over and explain how the indicator works, and it'll make more sense to you. So as we're looking in the chart here, it's also an oscillator like the relative strength index. So it ranges from 0 to 100. And then you have these 2 lines here. The dotted lines, there's one at 80 and the other one is at 20. So similar to the relative strength index, once the lines cross the 20 line, this signals that the security or the crypto is oversold. And again, if they cross the 80 line, then this is a signal that the security or crypto is overbought. Now, you're probably wondering, how in the hell do we use this as a trader? So once it crosses the 80 or the 20 line, that should just set off a signal to say, okay, the stock price or the crypto is at its extreme level. So be very wary that there might be a reversal in trend. But be wary that even when the price is at the extreme level, it doesn't guarantee that it's going to reverse. As you can see in the chart here, it broke out past the 80 level, and price just kind of consolidated and went sideways and then continued upwards. How traders would use the stochastic RSI would be when the blue line crosses over the orange line. This is commonly known as a buy signal. So as you can see here in the indicator, the blue line crosses over the orange line. And as you can see in the chart, price shooted up higher. And again, when the blue line crosses down below the orange line, this is usually a sell signal. So as you can see here, it crossed over, but the price kind of just ranged sideways. So it didn't exactly work there. So you just acknowledge that it doesn't work all the time, and don't use this indicator as a standalone. You have to use it in conjunction with other indicators and maybe candlestick patterns or chart patterns. So as you can see in this example, where the blue line crossed below the orange line, price did sell off. So another strategy of how to use the stochastic RSI is, so as you can see that the blue line comes below the 20 line, the 20 dotted line, and therefore the price is oversold. But it can be oversold for such a long time. You don't know the exact pinpoint area of when the reversal is going to happen. So what some traders do is they wait for the blue line to come back and break through the 20 line, and that could be a buy signal there. And if you can see in the chart that it did actually trend upwards a little bit. And again, you could wait for the blue line to cross below the 80 line, and that could be a sell signal. So there's many ways on how you can use the stochastic RSI. Now, comparing it to the relative strength index, as what I just said before at the start of the video, it's a lot more volatile than the standard RSI, in the sense that it will oscillate up and down more frequent than the RSI. Now, if I bring back the RSI and I just compare the two of them, so as you can see, the stochastic RSI will break out and tell you that it's oversold more often than the actual RSI itself. So you see here that it didn't break out over the oversold level, but in here it just tipped out. Again, here it just barely tipped out past the oversold, just the overbought level. But in the stochastic, it went way above the oversold line. And again, here, it just literally just kissed the line, where in the stochastic RSI, it actually smashed out through it. And again, here on the lower end, so when it was oversold, it actually, in the relative strength index, it actually didn't even tell you it was oversold. So both indicators are very good to use in conjunction with one another. Like, I wouldn't pick one over the other. They're both very useful, and they have their own benefits. Now, just the key takeaways is of the stochastic RSI. Remember that the blue line is often called the K line. It tracks the recent close in relationship to the recent range, which would be the past 14 bars. While the D line, which is the orange line, or sometimes known as the signal line, this is just a 3-period simple moving average percentage of the K line. So it kind of just lags behind the blue line. That's exactly how it's calculated. So the key takeaways is, once it passes the 20 dotted line, then you know that you're coming to oversold levels. And when it passes the 80 dotted line, you know then you are at extreme overbought levels. So what this indicator does is it stops you from FOMOing into the market. So if you want to buy a stock or a crypto and the RSI is at overbought levels, it's telling you that it would not be a good idea to buy at these levels, because the chances are that eventually the stock or the crypto will revert and it will start trending downwards, and therefore the price will probably follow. You can use this in many different time frames. So usually I like to look at it in the daily. So that would be in the last 24 hours. But you can also use it in other time frames. So say if you were trying to get an entry in a long or a short, so just to nail the entry, you could just go back to, let's say, the 15 minutes. Sometimes I like to do. So for example, here, so as you can see here today, Bitcoin had a huge pump. So it was after the SEC lost the lawsuit against Grayscale to do with the Bitcoin ETF. So that was very good for price action. So we've seen earlier on today that the Bitcoin price shooted up like 7%. And it actually hit like the resistance of like 28,000. And since that, it has slightly retraced. And as you can see, then the RSI is now at oversold. And like we could even bring up our fib indicator. So we're going to go from the low to that wick there. So in a previous episode, I showed you how to use the Fibonacci retracement tool. So as you can see that I'm bringing it from the low to the high, and you can see price action now is kind of trending downwards, but it hasn't quite hit the 618. So therefore, there is a chance that the Bitcoin could retrace a little bit more. But the RSI, the stochastic RSI, is telling you that it's oversold. But the relative strength index indicator is telling you that it's not exactly oversold yet. So in my opinion, I wouldn't put on a trade yet. I would wait until it gets near enough to the 618 and the actual RSI gets below the oversold level. So I hope this is actually helping you understand. So if you have any questions or if you're slightly confused, please type them in and I will try to get back to them. So that is your lesson on the stochastic RSI. I hope you're starting to understand and these are helping you in your trading journey. And if you're enjoying this trading series, I really would appreciate if you go down, hit the like, hit the subscribe, and leave a comment. It really supports the channel, and I will see you in the next episode.